What is Powell going to say if you had to guess?
So my guess is he's going to talk about
HELOC, or Home Equity Line of Credit. Today, we're asking the question, should you lock yourself into a fixed interest rate HELOC or roll the dice with a variable interest rate? Here's the truth. Nobody really actually knows what's going to happen to the interest rates in 5 years, let alone 5 months from now. That's why the real question isn't, what is the Fed going to do in the next meeting? The real question is, what makes the most sense for you? Today, Jason and I are going to discuss the differences between a fixed rate HELOC versus a variable interest rate HELOC and which one makes the most sense for you. And I think you'll be quite surprised by the answer. Welcome to the channel. We're the Clear Close, the mortgage experts that help you get clear to close on your next mortgage. All right, but before we move on, go ahead and give us a comment. What do you think makes the most sense in this market, a fixed rate or a variable interest rate HELOC? And remember, we're not talking about mortgages for purchases. We're talking about a HELOC. So Jason, for people who are wondering, I mean, should we always go for the more safer, conservative route and go for a fixed rate HELOC?
Yes.
Which is something that we offer on our platform.
We actually do have both options for our HELOC program. So you can do a fixed rate 30-year, get a 5-year draw, or you can do a variable rate with the 5-year draw. Similar concept, right? Fully digital process. But the real thing that you need to determine for yourself as a customer is why you think a variable rate is better.
Why?
Because for some reason, a lot of customers think variable is better because it's interest only, right? So that's usually not smart, in my opinion, because you don't know how risky it is because you're basically banking on potentially just interest only payments on that full amount that you're holding, right? So that means there's never any payment going towards principal. So you have to be super disciplined with your finances to use it. Or you have a fringe case where it's like, you're only using it for like short periods of time or bursts, or say, for example, you're in the process of a fix and flip and you're using that as your renovation fund, right? And you quickly want to exit. So that could be a potential use case for it. That's also the way that most of them have been designed in the past by all the banks and credit unions. So I think it's just more of a habit of people to just lean back to what they've seen at the bank every time they walk in.
Hey, I've seen this one.
And then you get your interest-only variable HELOC because it's just plastered everywhere every time you go to the bank. But reality is it's virtually impossible to get that kind of HELOC from a bank because banks don't want to give that loan out, in my opinion. So they're very
It's high risk.
It's very high risk because it's a variable rate and interest only. So you're layering in like loan level pricing adjustments for that type of caliber customer, right? So it's like they're going to have a higher FICO score requirement. They're going to end up having higher pricing typically for it, or your income doesn't work because with variable rates and interest only type loans, especially at the banks, they don't let you borrow up to 50% of your qualifying income. They're going to restrict it down to probably like 30 something percent, 32, 33, 36%. So it's like if you made $100,000, they'll only let you take on debt of up to maybe 35%. So $3,500 of qualifying income is what their total leverage would be. So it's like, it's harder to get those programs. It's not meant for everybody.
And the banks are always, lenders, banks, everyone who's lending money, they're always looking at the ability to repay because that's what the government says, that these institutions have to be able to calculate the ability for the borrower to repay. They don't want you to default. They want to mitigate the risk of, oh, I didn't realize that I had all this.
They're not in the business of acquiring real estate. They don't want your home.
No, thanks. Please. No, thanks. Yeah, no, thanks.
They don't want your foreclosed house.
They don't want your beautiful home, right? They want predictable payments on a type of loan that they're going to expectedly receive, right? With a high chance of payments on time, not default and having to foreclose. So just to get back to it, variable is not easy to get. It's possible, right? You're going to pay a premium for it if you do qualify for it. Whereas fixed rate HELOCs and second mortgages, or mortgages in general, they're easier to qualify for because underwriting, ability to repay. They're not having to add in additional layers to make sure you are able to qualify, because they know month 1 to month 360, it's the same payment. So they know as long as that payment schedule is followed, it will get paid to zero, right? That's why the fixed rate HELOCs, if you actually start comparing it, variable interest rates are not better in the long run. If I get you quoted for like a 7% HELOC, Peter, on our fixed rate program with excellent FICO, low, like the best pricing you can get, right? 7% as an example, fixed rate. That same loan, if you qualify for it on our variable program, is probably 9%, 9.25%, like 9.2. I priced someone out today, yesterday on that one. They're at 9.2 for that program, variable rate. So you're already 2 points higher than a fixed rate.
Wow.
So if you're thinking you have a crystal ball and you know the rates are coming down, you're already 2% higher than what a fixed rate is today. So you're going to have to see the market drop on the Wall Street prime rate
Like
200 basis points, 2%, over 2% to get that.
Wow.
So we're at 7.5 on the prime rate. So if that means you're thinking it's going to drop to 5.5 in what, 6 months, a year? Let's be real here. That's not happening. People, they think interest only is cheaper, but it's not if the rate's higher. Let's do the math, Peter, and put it up on the screen.
So we're doing, the loan amount is 100,000.
And do it at 7%.
7%.
That
The
principal
payment is
interest payment is
665.
what? Just remember that number, $665. Scroll back up. Now turn that into 9.2%.
9. Yeah.
What's
and then
that
the interest
only payment? It's $100 more than the fixed rate total amortizing payment. Because you're not paying any principal.
Oh my gosh.
And you're at a
that's
higher
crazy.
rate, 2.2. Money's not cheaper. You think it's better because you see interest only advertised, but it's not, because you're paying for it at a higher rate.
If the spread was closer, if it was like a point difference, like 1% different, then it would
show the difference. Well, let's see how much you have to get closer for it to be.
All right, so we're doing $100,000, 360. This is 6%. The total payment is $600. Okay, I'm sorry, 7%. It's 665 for the total payment. If the spread was 8% for a variable interest, the interest is still higher by $1. 666.
And the spread's not 1% between a fixed rate and a variable rate HELOC.
Why do they even offer a variable interest rate HELOCs?
Because that's what the investor wants. That's what the bank wants at the end of the day. So, and the fact that they offer the HELOC with the variable rate means they don't want to lend you money because you're not going to qualify. No, it really is. Like, the hardest loan to qualify for is an interest only variable rate mortgage or adjustable rate mortgage. That is it like the hardest loan to qualify for?
Jason, is it like, yeah, we have this?
It's more, it's advertising purposes, but you're not going to qualify for it.
But I want it now.
We have it. The banks all offer it. They all offer a 10-year adjustable rate mortgage.
I don't get it. Why would they have this
only
product?
But that program's only there so they can advertise the rate. The person that can actually qualify for it might exist, 1 in like 1,000. But it's not very common.
This is mind-blowing. But everyone on YouTube is saying, oh, HELOC is variable interest rate.
With a HELOC, you're going to have the interest rate that is most likely going to be changing. I've never seen them lock this in for the long term.
Don't do a HELOC because it's variable interest rate, but it's not true.
And everybody doesn't get a HELOC because of those people. And then when they stumble upon our program and offers, and that you actually have a HELOC that works, right, in a way that makes sense, it's common sense lending now, right? Some of these programs are just there at the credit unions and banks, and this is my personal opinion, just so they can advertise that they have the program. It's just another vertical product for them to upsell, but they really don't want to give it to you. If they did, they would offer a fixed rate HELOC.
I'm new. For everyone watching, I'm new to this industry, and I'm basically your stand-in to ask the mortgage expert all the questions that you would want to ask, but you're afraid to ask. Okay, so
And don't worry, I'm only beating up Peter because I know him so well. He's like family.
I don't take things personally. So uh,
A few moments later.
This is the reason why I wanted to talk about this one in particular today, because I knew you didn't realize the difference. And I had to show you.
I feel like you've set me up.
Because I have this conversation with so many customers, and it's just at this point, it's like I've gotten so used to it that I can just tell the customer to go to every single bank, spend as much time as you want trying to get that HELOC program, and not get it, because you have to learn too, and you have to learn how to ask questions, because that's the biggest problem. There's a lot of misinformation out there, because I know we've said it so many times before. Just because someone offers what's called a HELOC doesn't mean it's the same HELOC from person A to Z and everyone in between. It's going to be different. And this is where the bank programs are very hard to get, because they're not designed for everybody. They have other programs that they can sell you, like a cash out refinance, right? Or rate and term. And that's why a lot of direct lenders out there too, like the big names, have programs, but they're not priced where it should be in the market, in my opinion. It's more of I have the product too, but it's more of a comparison tool, in my opinion, to use something else. Because if I see a big box lender, right, they're like, I have the HELOC, but it's interest only. It's lower rate, but there's only like a very small pocket of people that'll get it, right? And then they have this is the real product you can qualify for, which is the cash out refinance, right? Or you can get a second mortgage, but that second mortgage is so expensive, it doesn't make sense for me to sell you this product, Mr. Borrower. I'm going to sell you the cash out refinance. And a lot of people go down that path. There's nothing wrong with that if it makes sense for them. I personally don't like it.
What is the incentive for the lender or the bank or institution to sell the cash out refi instead of the HELOC?
Way more money to be made, because now it goes to Fannie Mae or Freddie Mac, and that loan is several times bigger than a HELOC. So
Oh,
it's like
right.
it's a business for profit on that side. But
Oh.
so for a lot of people, it's starting to make sense to do a full cash out refinance, because the people that have bought homes in the last 3 years have bought it at much higher interest rates. But you still have the outliers of people that during the COVID pandemic, a lot of people took advantage of the low rates. And there's a huge population where it doesn't make sense to do a cash out refinance. That's why
Right.
HELOC is gained so much popularity over the last couple of years, because people have 2% interest rates, 3% interest rates. It doesn't make sense to do a cash out refinance that's 7% or 6.5%.
Yeah, that's crazy.
It's nuts. And on the largest amount that they owe, when they only need a fraction of it, right? So it doesn't make sense to me, in most cases, if you can qualify for a HELOC, to do a cash out refinance, which is why I'm not a huge fan of cash out refinance, unless you have a major debt problem that can't be fixed with the HELOC. Those are the times where it's like you have to do a cash out refinance. Like I am running into clients right now that have no choice but to do a cash out refinance. Like they don't qualify for a HELOC. They want a HELOC. They love our videos for it. But unfortunately, your only solution is a cash out refinance, because again, you're not going to qualify for it. Like if I can't qualify for a HELOC, it's going to be very hard to qualify for a bank HELOC, because variable rate and longer draw periods and the risky nature of a second mortgage, that's not something easy to come to make work, especially if you're not over 720, 740 FICO score. Like once they price you out and you're at like 700, it's pretty bad. And then it's like you go below 700, you don't qualify at all in most lenders' cases. So again, it's like fringe use cases. I personally like the HELOC for most people. It's a good product for them today, especially if they have plans on how they're using it. And because we have a ton of equity in our homes, like there's so many people right now, you might not be in a debt situation, but you might be sitting on a very large chunk of equity that you've been struggling with what to do, right? Because you feel like you might be missing an opportunity. Like I feel that way. That's why it's like knowing you can tap into your equity with programs like this, it's pretty awesome, because where else could you realistically, with excellent credit, with very good qualification, have access to hundreds of thousands of dollars for single digit interest rates? You can.
All right, so that about wraps it up for us, you guys. Whoever commented, whoever put variable interest in the comment section, I'm sorry, you're according to this video, you're absolutely wrong every time.
I mean, here's the thing though, like if you really want variable, get it. Go for it. You can try it. I have it too, but it might not be the best solution, or it might be the only way actually for you to get a program too.
So let's sum it up. Let's wrap it up for everyone here. At the end of the day, it's not really about predicting what the Fed's going to be doing. It's more, I would say, about your situation, your personal financial goals and needs at that moment. And clearly, this landscape of mortgages and second mortgages, like HELOCs, equity loans, it's very complex, especially with these equity type of loans. There's so many different guidelines, variables that you are not privy to as someone who is not on the other side of the computer screen. So use that link in the description, subscribe to the channel to learn more so you're not caught off guard. And we hope to speak with you guys soon over the phone or in the comments or whatever. Jason, do you have anything to say before you sign off?
Yes, this is why I am very happy to be a broker, because it's our job and opportunity to help find the right solution for you. So again, just because you hear no from a bank or a direct lender, it doesn't mean it's a no for sure for you. So if this sounds like something you could benefit from, click the link in the description, set an appointment. We'll get back to everyone as soon as possible.
All right, we're the Clear Close, and we'll see you guys on the next one. Bye-bye. And if you want a deeper dive into what actually does affect purchase mortgage, you can click on this video icon on the top. Or if you want to learn how to avoid the most common mistakes people make with their HELOCs, click on the video at the bottom.